net contribution, and cash flow analysis. Now I'll be going through a series of simplified financial analysis statements for a new location to show examples of what I've talked about earlier in the course. We'll be looking at an analysis for a company called Jack's Beanstalk Beans. You may remember the story of Jack and the Beanstalk. Jack trades the family cow for magic beans. These beans grow overnight to a massive beanstalk that reaches into the sky where a giant lives. Jack steals from the giant, then kills the giant as the giant chases after him. It's a fairy tale with a questionable moral ending for small children. It's not every night that you soothe your child to sleep with a tale of theft and manslaughter. Tax CPAs consider it a cliffhanger because the story never resolves if Jack claimed the stolen goods as income or is guilty of tax evasion. In some versions of the story, Jack is just stealing back items that the giant stole from Jack's family in the past. This is much less troubling for children and tax CPAs. Jack now sells these seeds to farmers, curious travelers, and a criminal element who want to know if there's anything else to steal up there. Jack was selling seeds from one location. He's now opening a second location in the north. The example we'll be walking through is in a workbook titled New Location Analysis. You can download this workbook to follow along with the lesson. You don't have to do this because I'll be showing screenshots along the way. The workbook can also be used as a starting template for you to customize for analyzing new locations. The first worksheet breaks down the components of gross profit. There are two sections to the gross profit worksheet. The top half has the components of gross profit at the new location. The impact on gross profit of the other locations is on the bottom half. I mentioned earlier that it's better to model the new location dollar amounts in one part of the analysis and the impact on cost to the rest of the company in another part. It's easier to model the assumptions and see the impacts if they aren't combined by being netted together. The profit worksheet can also then be used as a budget sheet for the new location. The revenues and costs from this sheet are carried over to the contribution analysis sheet we'll look at. Different versions of key assumptions like the number of bags and average price per bag can be quickly changed on this sheet to come up with different gross profit scenarios. The row for titles on the far left of the worksheet are the key assumptions I talked about earlier in the course. Jack's unit of sale is a bag of beans. Gross revenue is the average price of a bag of beans times the number of beans sold. Cost of goods sold is the average cost per bag times the number of bags sold. Let's start with the top box of the new location. The new store doesn't open until April, so there are no sales until April. The April opening is a soft opening, where the new location isn't heavily advertised while the new staff work out the kinks of the new location. The grand opening celebration and sales event occurs in May. That's why the number of bags spikes in May. Notice the average price per bag drops to $6, which is their cost. They are running a deep discount promotional sale. We'll also later see a spike in marketing costs in May. Sales drop back down in June and slowly rise during the rest of the year. Now let's look at the box that analyzes the impact on the rest of the company. The first row of this box shows that sales at the other locations will go down when the new store opens. This is an example of sales cannibalization. The new store is cannibalizing sales from the existing locations. Jack is estimating that 10% of the sales at the new location are from cannibalization. Look at the May change in bags sold. Cannibalization doubles to 20% of the sales at the new store. This is because existing customers are drawn both by the convenience of the new store and by the low price. The average price per bag in the box on the impact of the rest of the store is always $10. That's the regular price the existing customers would have paid. In May, many existing customers don't pay $10, but instead visit the new store to pay only $6. The decrease in sales price for those 2,000 customers is price cannibalization. The staffing worksheet lists the staffing costs of the new locations and changes to staffing costs in the other parts of the company. Once again, let's start with the box that analyzes the new location. The new location is very leanly staffed with a manager and 2 employees. The store doesn't open until April, but the employees start in January. This is an example of costs that start well before the revenue of the store. This analysis assumes that benefits and payroll taxes are 30% of salaries. For analyses like this, it's common to project benefits and taxes at the same ratio to gross salaries as your existing locations. The total of salaries, benefits, and payroll taxes will be carried over to the profit worksheet. The second box looks at the staffing cost changes in other parts of the company. The first line is a change in employee costs from transfers. The manager at the new location was promoted from another location. The old location hired a new person that is earning $1,000 less than the new manager's old salary. The second line reflects the need to hire another administration person to handle the increase in staffing and locations. The first thing to note about the contribution worksheet is the title. It's called a contribution statement. It shows how much profit the new location contributes to the company. If you want to title this as an income statement or profit and loss, P&L, that's okay too. The first two lines are the sales and cost of goods sold from the gross profit worksheet we looked at earlier. Salaries, benefits, and payroll taxes come from the staffing worksheet we looked at earlier. Supplies are very high the first month because the new location is stocking up with supplies. It then drops back to a much lower level going forward. This is a simplification. New locations usually have high supplies costs for the first few months because they buy things over time and keep finding out new things they need. I made very simple assumptions about rent, utilities, insurance, and travel. Jack's Beans is renting the location rather than buying or building. You can see the advertising for the grand opening in May. After that, the advertising costs for the new location will likely be higher than other locations, but much lower than the grand opening. Jack only needed to pay for some of the tenant improvements. He also bought some equipment and furniture. He has a very low depreciation expense that starts when the location opens. I mentioned earlier that it's a good idea to have an other line to capture expenses you don't anticipate when planning for the location, but seem to crop up every time you open one. The gross margin minus expenses equals the net contribution before taxes for the location. All the parts we talked about so far could be used as a location budget. This is also very useful for when the projection starts mid-year and then you need to make an annual budget for the location when budgeting for your next year. I was very intentional when adding before taxes to the title of the net contribution totals. Contribution analysis is often done pre-tax. I did it that way for simplicity in this example. It's very appropriate for nonprofits and pass-through entities like LLCs or S corporations. You may want to model the tax implications at the location level or as an impact on the rest of the company. This might be especially true for projecting cash flows because a new location could provide very large deductions in the early years. I've said a few times that I prefer to model the location's amounts as if I'm building a budget for that location. I then model the other financial impacts on the company below that. Jack's simple contribution statement has two examples of this, both of which were discussed in earlier worksheets. Existing customers will stop shopping at existing locations and start shopping at the new ones. Some will do this permanently, and some will only stop by the new location to take advantage of the grand opening sale. Putting this cannibalization on one line reminds me that I need to adjust projections for the other locations. I may need to add these adjustments when putting together next year's annual budget for the new location. I may need to adjust sales targets in the current year for the existing locations. For example, the managers of the existing locations may have incentive compensation or bonuses tied to sales at their locations. Those sales levels may have been made before deciding to open the new location. It would be unfair for Jack to hold them to sales amounts made before the company decided to open the new location. The leaders of the company are making decisions for the good of the whole company that penalize the incentive compensation of the existing store managers if the sales targets aren't adjusted. The new location caused a small decrease in salaries from a staff transfer, and the company had to hire another employee to support growth. These costs are in the staffing line. The location net contribution, plus the impact of the company, total to the total net contribution before taxes. The cash flow worksheet looks very similar to the net contribution statement. One difference is that it starts and ends with the cash balances. The gross profit section is now titled Cash Inflows. Jack runs a retail outlet and doesn't sell on credit. His accounting revenue matches his cash from sales. You also won't see accounts receivable on the balance sheet. The line that used to say cost of goods sold is now titled Inventory. It starts with a large cash $100,000 outflow in March to stock the store. From April through December, I used a simple assumption that Jack restocks inventory as it's sold and that he doesn't buy inventory on credit. There's no accounts payable on the balance sheet. The cash outflows for expenses are similar to the net contribution statement. One difference is that the depreciation line on the income statement is replaced with the cash paid for tenant improvements, signage, and equipment. Once again, I assumed Jack used cash on hand for these and did not finance them. There may have been a tenant improvement allowance in the lease that offsets some of the total cost of the tenant improvements. There is no debt on the balance sheet. The impact on the rest of the company is the same as the contribution statement. All of this totals to the net change in cash flow. I mentioned earlier that you might want to model the change in cash flow from tax deductions of the new location. The last line on the worksheet is a running total of the cash balance. Notice that the total cash consumed by the new location is $452,500, which is much higher than the $241,500 net loss on the contribution statement. The $211,000 difference between these two numbers lies on the balance sheet. Cash on the balance sheet ends at negative $380,500. I pointed out that this new location consumed $452,500 of cash. Why isn't that the cash balance? This is a balance sheet for just the new location. The remaining negative cash and equity will flow onto the balance sheets of the existing locations. Inventory is $100,000. Tenant improvements and equipment net of depreciation are $111,000. We've found the $211,000 of cash outflows in excess of the location loss. It's invested in the inventory and fixed assets. Equity for the location is negative $169,500, which matched the total loss on the contribution statement. I've mentioned a few assumptions made in this example so far that have greatly simplified the balance sheet for example purposes. This is obviously a simple set of financial statements to show some of the key points throughout the course. Let me briefly mention a few options and complexities you can add to this. Most of these are reflected in the balance sheet. First, some of you CPA types out there may have noticed that this balance sheet doesn't reflect the recent lease standards. Those would require me to add a right of use asset and a liability. You may want to model these if they could cause you to fall outside a debt covenant ratio. In this example, all inventory was paid with cash and sales were also received instantly like cash. It's more likely that a company buys inventory on credit and may also sell on credit. This would create accounts receivable and accounts payable. I showed earlier how the timing of these items in your cash conversion cycle can create permanent working capital that needs to be funded. Jack is leasing, so this example doesn't show a building on the balance sheet and a cash outflow for a down payment. These are significant amounts that you want to model if you're buying a new location. And finally, if all this seems too fanciful, please remember, we're discussing an analysis of a company that sells magical beans based on a fairy tale.